With interest rates going up, people are looking for affordable places to invest in, where even if interest rates go up, property prices will still grow, it will still be positively geared. However, some are making mistakes. In this video, I'll share one location where a lot of people are buying, but for mine, you should be careful to invest. Perhaps you shouldn't invest, okay? If you're interested in both sides of property investing, where to, but also where not to invest, then carry on watching. My name is PK and I help people build passive income using data without needing a buyer's agent, $15,000 every single time. This channel exists to help you get ahead in property investing, understand the economy, and achieve financial happiness. If you're interested, give it a subscribe, give this video a thumbs up, turn on a notification bell so that you get alerts for each and every video. Okay, I do one every 2 or 3 days. Let's get into it. So where am I talking about? This is Queensland right here. You can see Brisbane is over here and Cairns up here. If I scroll in, beautiful part of the world, to Mackay. All right, there you go, Mackay. Nice place. Have nothing against the place. You know, beautiful place next to the ocean there, the reefs, you know, awesome, awesome, awesome. However, let's get into the data. Okay, so a lot of people are buying in Mackay. A lot of interstate investors are buying Mackay. A lot of buyers agents are getting their clients in Mackay. None of this is financial advice, but here's my 2 cents, just based on a few facts and figures, right? So it is affordable, right? And that is one of the draw cards. You know, people are like, I want to buy something under $500,000. I want something positive cash flow. Mackay ticks those boxes, but that doesn't mean that you should be buying there. Let's go through it real quick. So the LGA is a coastal area located, like I said, in northern Queensland. You know, it's close to the reef, which is awesome. In the past 5 years to 2020, there's been a 0.6% increase in population. Population isn't everything, but it is one indicator to be aware of. So 0.6, you know, isn't fantastic. It's not bad, but yeah, it's so in line with expectations for a regional area. A high level of infrastructure and commercial projects are planned in 2022. That's great, you know, that's awesome. And, you know, with COVID, you know, people are moving there from the big cities. So unemployment is very low, okay, 3.5, well below the Queensland average. So that's awesome, you know, like Mackay has traditionally been a mining town. So this is finally good that the economy is finally booming in Mackay. And a lot of people may think, you know, tick, 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 everything's going good, let's buy in Mackay. But hang on, there's so much more to understand. All right, so the median land price growth in Mackay in the last 10 years was 5%, you know, not awesome, especially compared to the Whitsundays, which is 22%, and Toowoomba. And between 2012 and 21, median house prices softened by 5.3%, median unit price softened. Okay, so land has obviously gone up, but house prices haven't done that great. Now, that's one key piece of concern already. It's not a deal breaker, you know, just like in Perth, last 8 years have been pretty terrible, but we're buying a whole bunch in Perth. Okay, so by itself, none of these indicators tell us everything. In December 2021, investors in Mackay benefited from average rental yields of 6%, you know, so that's obviously awesome. And units a little bit even more. Vacancy rates are really low. In December 2021, have trended within the 1% range for 18 months. Okay, that's awesome. And obviously the median entry price is much lower than Brisbane. So even a lot of Brisbane investors are buying Mackay because it's cheap. Yields are low. Yields are high. Vacancy is low. Where could you go wrong? All right, so Mackay local government area is set to see an estimated additional $1 billion worth of projects coming through, with a large component of this being infrastructure, tick, tick, and commercial developments, tick, tick. Combined, this will improve livability, services for residents, local jobs. I mean, everything is looking up. So why on earth am I saying that you have to be careful buying here? There are 3 or 4 reasons. The first is that there are a lot of lots planned in 2022. Okay, so for Mackay, which is a relatively small place, it's not a, you know, less than 10,000 person town or anything like that, but it's still 1,000 new lots, a lot of supply coming on board, which we don't like. And, you know, without looking at trends, it's so easy to just go on CoreLogic or see things like this. By the way, it's a great report by PRD. That's the source for all this. Without looking at trends, you miss what's actually going on, because even though the vacancy rate is pretty good, around 1%. What I will say is that traditionally, even in 2020, it was up at beyond 3%. That's not good, okay? So that's not good. What this shows us, it's only because of COVID, the stimulus, and the flight to regions that this particular region, Mackay, has actually come in demand. Okay, and if that trend ever reverses, then all those people investing in Mackay can easily lose money very quickly too. The supply story is really bad. I talked about the lots. The stock on market percentage is more than 5%. So what that means is that for every 100 houses, there are more than 5 houses for sale. We want that really to be much less than half of that, even more than less than half of that. Okay, so 5% is not really good. And the yields have traditionally been good, but the capital growth has not been good. And so even though the demand side, infrastructure, population, everything like that is doing good, the supply side, in my mind, is just not good enough. Okay, let's go through a little bit more. Area sales and median price. Okay, so you can see that median house prices, this black line, really came down from beyond this mark here in 2012. Mining boom busted. It came down, let's call it $50,000 to $100,000, and now is catching up. Okay, now is catching up. So that's good, right? I mean, we're not afraid of a pattern like this, the fact that it's consistently going up. One thing that I'll call out is this house sales. Okay, some commentators, experts, pundits, buyers, agents say that house sale transaction activity is a good leading indicator for house price growth. You can see how that's not actually true. This red bar, house sales have been going up since 2015, consistently, but prices came down. Okay, so when you look at the data, you start to make up your own mind of what's going on in an area. Don't just go by what other people are saying, even if they're all across the media. Don't even trust me. Okay, look at the data. So key facts: house median value is 412. Median land value is 209. So that tells us the land to asset ratio is traditionally quite good. In Makai, vacancy rate is good. This masks the fact that just before COVID, vacancy rate was more than triple that. Okay, so be cautioned. Rental yield is good. However, in this part of northern Queensland with cyclones and everything like that, really you're looking at least, I would say, $2,500 to maybe even sometimes $3,500 just for insurance. Okay, so if you compare this with, let's say, a yield in Toowoomba of 4.5%, it's quite comparable. Okay, that's the reality. Don't be fooled by the unit rental yield either. Remember, there's strata, admin, sinking levy fees that brings this down to mid-5s as well. This is what I have a problem with this 979 lots, and also the fact that stock on market is more than 5%. That means that in the future there's too much supply given this lot allotment. And right now there's too much supply. No doubt prices are going up, but what this tells us is that prices are going up because of the general tide, because all of Australia is going up because of macro factors like stimulus and things like that. And when those macro factors go out, this area is most likely to suffer compared to others where the local data is very good. Remember, sometimes all of Australia goes up and some areas don't do that well. Sometimes all of Australia goes down, but some areas do really well. There are always markets within markets, regardless of whether interest rates are going up or down. Okay, inflation's going up or down. Just be conscious of that. Unemployment rate is very good now, though. I just wouldn't say I have enough confidence to invest in Makai myself, nor will clients, according to the data system they follow. So none of this is financial advice. I'm just saying be careful. Just because it's positively geared, vacancy rate is low, there's big infrastructure going in, and it's under $450,000, doesn't mean that all of a sudden you should be investing here. And this is exactly what I was meaning in terms of vacancy rate, So you can see that for Makai, it's it's been quite high. In fact, this is the overall vacancy rate. If you break it down, house versus unit, it's actually higher as well. You can't really compare this to Brisbane Metro includes units as well, and units were just trash in Brisbane, so not the most fantastic chart. And once again, that's a lesson. You need to actually get data that is reliable, that actually is meaningful. All right, so if you compare this vacancy rate data to CoreLogic, to SQM, it's all different. Okay, you need to know which to trust and which not to trust. Hopefully this is kind of building your knowledge. I'm not giving you a yes or no in terms of Mackay, but I'm hopefully educating you so that you can be more cautious, more circumspect, more measured, more quote-unquote intelligent in making these significant decisions. For mine, I wouldn't buy in Mackay right now, but hey, everyone's got their own risk appetite. One key point that I want you to take away is that there are markets within markets. Regardless of what happens with interest rates, there will always be markets that will produce double-digit growth. I'm not just saying that. Okay, it's easy for me to say that, property spruik and all that sort of thing. That's just traditionally, historically, what's happened, even in interest rate growth cycles. Watch that space. My name's PK. Guys, if you want to level up your knowledge, really understand all of this stuff, 30 to 35 data factors, and make the most of the next 1, 2, 3, 4 years, even in a debt tightening cycle, which I think for mine will last 1 to 2 years, and then it will loosen up again. I'll do more videos on that, explaining the rationale. Then I'll leave links to this podcast below, Facebook group, 15,000 people. And yeah, just level up, guys. It's so important. Okay, give it a subscribe, give it a thumbs up. I hope this brought you value. My name's PK, and yeah, all the best. Catch you later. Bye.